Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Vince Parrack, a familiar face you might recognize from last year, who's sitting in for Dan Cedar, who is off-site. So today we really wanted to just focus on this trade war, these tariffs that have come about over the last couple of weeks, the impacts that they will likely bring, and overall this trade war time bomb, the fact that it has hidden implications for your investment portfolio. We think it's very worth understanding, at least from our point of view. So specifically, what we're going to try to do today is educate you all on some of the historical context behind these tariffs, as well as some of the sector-specific implications, how to manage some of the risk involved, and then finally, we'll talk through some of the things that we here at Blue Chip Partners within the investment committee are actively investigating. And hopefully we'll all come away from this with just a better general understanding of some of these hidden risks that this trade war time bomb can potentially bring to investment portfolios. So first and foremost, what I would say is that as these types of items have developed, so think about global diversification, global supply chain diversification, and just globalization overall, one of the issues that was exposed through the pandemic was the fact that we have been very reliant on global supply chains. So as the world shuts down, we all know what happened thereafter. It was really hard to get things, socks, sofas, whatever. And so as a result of that, the whole reshoring theme has been somewhat prevalent since then. You layer on the fact that tariffs and trade negotiation tactics between countries have become increasingly relevant since pretty much 2017. And you have these knock-on effects that have really started to surface. So just even looking in recent years, restrictions that the U.S. has placed on the semiconductor industry from an export perspective, certainly that impacts chip producers, but it impacts just about everybody else as well, given the prevalence of semiconductors. And so even though we've had a general decrease in global reliance for supply chains, because these trade negotiation tactics have become ever more prevalent, kind of like a domino effect, the share of GDP that's actually impacted by these types of trade restrictions has increased. So I think that's just one interesting call out as we start the conversation. So when we talk about a trade war, the general ideas we're talking about are, this type of thing that happens when countries impose tariffs on one another, whether they're explicit or barriers or just regulatory hurdles. These can often trigger retaliation. These lead to higher costs, supply chain disruptions, and market volatility overall. So why exactly should you guys care as investors? Well, number one, these trade disputes and trade wars don't just impact big corporations. The ways that they impact investor portfolios are not always going to be obvious, and that's exactly what we'll try to jump into today. But realistically, trade restrictions can drive up costs for both businesses and consumers alike. They can impact corporate earnings in a big way, depending on what these tariffs are targeting, what countries they're affecting. And I think the headline issue is that these types of actions are going to increase market volatility.
Yeah, I mean, particularly when the timing, the announcement of tariffs is, not super consistent. I think that's always gonna, definitely create the higher likelihood for market volatility, which no one likes to see. But, I think taking the conversation someplace, I think interesting to begin, like when would tariffs be effective or when are they necessary? Because I think a lot of times it's easy to think, well, you're either in one camp where, hey, the tariffs are going to restore jobs and build back American manufacturing, or you're going to say, no, technology in the manufacturing process is eroding, jobs quicker than tariffs are going to bring them back. But I always think of tariffs as that they can be effective, right? I mean, number one, the U.S. does have some leverage. We're one of the biggest, if not, the biggest consumer of probably all of the goods that we're placing tariffs on. So we have some leverage in the global market. are tariffs the right way to go about it? I think we'll see. I think that, you see these wild estimates of jobs that will return to certain industries that may or may not be incorrect. They may or may be a fraction of what's estimated. But you do find tariffs to be necessary when certain countries are so-called dumping. Yeah. So there are situations where companies will manufacture a good below cost, essentially, to gain global market share. That is unfair. That's a completely unfair trade practice that absolutely would warrant a tariff being slapped on. So there are instances with that. I think the most recent ones with steel and aluminum. We'll see. It's likely that they will increase prices and maybe decrease demand. But if the overall plan is for the U.S. steel producers and aluminum producers to, let's say, put some CapEx into their factories, start to get competitive from the manufacturing standpoint, that could be a good thing long term. But I think the tariffs need to be met with some type of greater vision for these two respective sectors.
Right. Yeah. And that's, I would call it bully ball, so to speak. Some of the rationalization for actions like this could be, well, we're actually just meeting the trading counterpart where they are at, right? Whether or not that's the case, I think that looking at portfolio vulnerabilities specifically right now is a great way to kind of move the conversation forward. So you can think about direct exposure risks that are very obvious, but then also some indirect exposure risks, the more knock-on impacts that I think are really interesting. So specifically when we think about Canada, Mexico, China, the headline tariffs that have been announced, some of which have been formally put in place, some of which have been put off, where do you guys see as some of the most both direct and indirect knock-on effects for companies that are publicly traded today? Industries, sectors, companies, whatever.
Yeah, so one for sure, and we kind of saw this last week, is auto manufacturers. So they import a lot of their components and they do a lot of the actual construction of the vehicles overseas or Mexico. So that's a large one that was impacted last week, and that's more of a direct one rather than a knock-on effect, but certainly one of the most prevalent off the bat.
Yeah, I think autos, that is relevant for both what's gone on with Canada, but also Mexico. You can even lump China into that too. So like autos, I think, are probably the most impacted. Realistically, the autos have kind of gotten the short end of the stick in so many different ways over the last 10 years, because even as some of the chip restrictions came about, like that hinders them in a big way as well. But when you think about Mexico, the U.S. OEMs have done a lot over the last 10 years to take production to Mexico. And this is a really big deal as it pertains to these tariffs, because to pose some increased costs in that supply chain is going to be a very, very challenging story.
Right. And in theory, the tariffs, the effect of the tariffs should be relatively temporary, right? If the goal is for U.S. producers to get competitive, and get online and compete in the global market, well then, hopefully in some short order that would happen, and you would see these tariffs not necessarily affect earnings in perpetuity.
Yeah. It's just, to me, it's like you can't, I think shifting around production, I just think this is more than, obviously more than a 12-month story. This is more than a 4-year story,
well,
right?
And I think, what's not going to happen is, you're going to see prices go up for autos, and I have a hard time believing that they're just going to see them come down as soon as steel prices correct, right? You didn't see that during COVID with some of the supply chain issues that autos had. Particularly, you saw the MSRP, the window price of these cars increase dramatically, and here we are. Yeah. They haven't come back down.
Yeah. I think another interesting one is, you could put this, I would call out like aerospace and then also consumer goods. Aerospace, because tariffs on Canadian raw materials like aluminum, they're not just going to affect, the big wide body suppliers like Boeing, but really suppliers across the entire aerospace sector. Then also in consumer goods, I think companies that are heavily reliant on Canadian paper. So Canada is a pretty big commodity producer and exporter, right? So everyone thinks about the energy space, oil and gas. Of course, that's true. But also other things like lumber, packaging materials, all of that stuff, like facing higher costs there, not only does it impact companies' ability to compete on pricing, but that's just going to hit our wallets
straight up, I think, right? So that's a really big consideration when you look at some of these kind of classic consumer packaged goods type companies, whether it's a Procter and Gamble or a Kimberly-Clark. And I do think that like that's also true in Mexico, maybe in a different light, but things like, I don't know, avocados, right? Things like that. There's a lot of that kind of household type item exposure that I think is going to be a very big consideration, especially if you look at the consumer staples sector overall. What about China? I mean, China has been one that there's obviously been trade spats that have been ongoing pretty much since 2016, 2017. Those tariffs were maintained, if not increased, but now they are taking another leg forward, and this has been a continuously developing conversation. What do you guys see as some of the headline affected industry sectors, companies there?
Yeah, I mean, I think the first one that comes to mind is technology, semiconductors. I mean, a lot's happened in that space over, tighter export restrictions. Actually, these are how trade wars can escalate, where you can actually just not export a product to a company. And, the U.S. has tried to, make sure, in some cases successfully, maybe in others not so successfully, but not let these, most advanced AI chips, NVIDIA chips go to China. So those are the kind of things that you see. And, the U.S. speaking, when I say we probably have a lot more competitive relationship with China than necessarily we should with Mexico and Canada. I mean, they're, our northern and southern neighbors. I think that it makes sense for us to have a lot more friendly trade relationship with them. But China is kind of a completely different animal, and they're much more of that direct competitor.
Another thing I found interesting with the China tariffs is there's potential for the small item exemption to be removed, which is any item under $800 would not have been tariffed. They've currently have that on pause essentially because they're trying to figure out a way to actually manage that. But for places like Temu, like the amount of packages and just goods that come over from China from Temu is massive.
I would love for that to be stopped.
Yeah,
those banner ads on your computer are like the most ridiculous ads and things that I've been like, nobody needs this product. This should not be even made.
Yeah, so it's been, I think, pretty sure the number is 800. Anything under 800 hasn't been subject to tariffs, but going forward it may be.
And they get around that, right? Because every product, so a shirt will be 50 cents and they can put, effectively 1,600 shirts in a box and say, oh, well, it doesn't get tariffed. Mm-hmm. Yeah. So they have a complete workaround that's kind of bogus for this system anyways. Yeah. That to me is dumping. Like that is,
yes,
I agree.
That is not an okay practice.
You called out the high performance computing, like that has very much been a headline development we've seen. As it pertains to kind of what's happening right now, I think the other part of this that needs to be thought about is it's like actually not the high performance stuff now. It's the standard kind of old school computer companies, because like they all have a heavy reliance on Chinese manufacturing, right? So think like laptops, servers, networking equipment. This is Dell, HP, Cisco. Huge reliance on China for production and components.
I mean, Apple,
like,
right?
Apple for sure falls into that too. Like I think those, like, call them the hardware producers, right? Like that is, I think, going to become a pretty big deal, and understanding how to manage the confluence of supply and demand there is going to be something that's really closely watched over the next few quarters, depending on how long or how persistent these, and I guess how intense these tariffs are. I think when you think about China, you think about technology in terms of our relationship with them, right? Yeah. Other thing I thought was kind of interesting, and we've talked a little bit about this type of stuff in the investment committee, but the retail space. So I'm thinking places like Target, Costco, even a Hasbro and Mattel. Hasbro and Mattel, toy manufacturers. I mean, anything small bit manufacturing like that. I mean, you're going to probably be partnered with China just for cost advantages. But then also like Target and Costco, they have a ton of their top and bottom lines that are sourced from things like furniture, right? So retailers that are importing furniture, clothing, and even electronics from China, like they're going to face higher costs. A lot of that's going to get fed down to us, depending on the persistence and intensity of these tariffs. Yeah. But I think that retail space is one that might be a little bit overlooked as well. And, the knock-on impact of all of this, I mean, it just all flows downward, right? Like we're trying to emphasize the fact that even though it's very clear to find sectors, industries, and companies that are being impacted in a very direct way, the indirect knock-on impact can be by way of increased costs borne by consumers. It could also be by way of sheer just increased interest rate expectations, which can stoke market volatility. I think that's the biggest unseen consequence or unforeseen risk of all this, is that it's actually not nuts and bolts, ones and zeros on financial statements. It's the expectation for changes which can stoke volatility, right?
Yeah. I mean, that's well said. And like I said, we'll kind of see what's going to happen with this. I mean, and ultimately, one of the great part about buying quality businesses is it's up to the leaders of those businesses to figure this out, right? They don't get to just throw up their hands and say, okay, well, we got to take our ball and go home.
Yeah.
They're in charge of supply chains. They're in charge of figuring out workarounds or ways to deliver for shareholders and consumers.
Yeah. So third kind of part of this conversation, things that we should be watching, both kind of at the headline political level, but also at the kind of sector, industry, company levels. What should we be watching for? And I guess I'll opine on the latter part of this, but like some of the things that we're actively looking at right now or expecting. Do you guys want to kick that off?
I would say, obviously, when we're talking about tariffs here, there's a lot of feelings of caution. Investors think that a lot of businesses, you kind of get a feeling that all businesses will be negatively impacted, but there are going to actually be opportunities within here, partially related to like sentiment around tariffs. So as we saw, obviously, there's a lot of volatility happening. Things are moving quickly. Last week, we saw the market sell off because Mexico and Canada tariffs were expected to go into effect soon after the market opened. That got pulled back, pushed forward a month. So there's certainly opportunity to capitalize on potentially inconsistencies in sentiment or like over exaggeration of sentiment. Like you said, there's a couple businesses that we're looking at now that may be in that category.
I think, for me, it's the reminder that although this might be a speed bump in markets or a certain company's performance, I mean, the overarching themes that are driving stocks higher, and when I think about like these secular stories like data centers, AI, those aren't stopping, right? They might be slowed temporarily, but if you keep your eye on the prize and the longer term view of a lot of these things, they really shouldn't be overly affected longer term. In the short run, but longer term, I think it's going to be a blip in the radar.
Yeah. And I like what both of you said, because so much of what we talked about kind of through the bulk of this podcast is like, how can you potentially play defense, right? Now it's kind of like, well, certainly defense, risk management, that's paramount. But the next leg of this, I think one of the hidden risks to all this is that you're not identifying opportunities to play offense as well, right? Like that's understanding, hey, if we've got some really dislocated opportunities for a company that's exposed to this massive secular growth opportunity, and it's, multiple has come in by 10% and it shouldn't have, that sounds like a fantastic opportunity to me, right?
Yep.
The things that I think, one thing that worries me in terms of like warning signs and things to monitor, like the biggest risk to me is that all of these trade war oriented actions, it's not even the company level impact or the sector level impact. It's just the emotional kind of perception that it stokes within the investment community. And that can just drive trading in a way that is basically dislocated from fundamentals, right? So when I'm thinking about things, I mean, looking at shifts in policy language from the Fed, right? Like driving up inflation expectations because of this, that becomes really, really hard to focus on business fundamentals, because even if you can map that out and model out the impact of inflation, perception is reality. And however investors perceive the impact is going to be what's traded like reflective in the market. That's really a big kind of concern of mine. I think that's a warning sign. The other thing I would say that we should really watch for, any investor should watch for, is active updates on retooling supply chains. We talked about how this is more than a 1 year, it's more than a 4-year experience if you're going to try to move production in a meaningful manner across geographies. It's going to be really interesting to see how much credit investors give companies for committing to doing that and how they weigh that against the costs that are going to be involved. I think it's going to be really challenging for companies to do that. But if they do it right, obviously, like Matt said, it can kind of benefit domestically long term. It's just a matter of how patient investors are going to be willing to be. So there's obviously other things like, currency risk and all that, which I think should be a consideration. But realistically, there's just so much that is involved in all this that you kind of have to just have your eyes and ears open all the time as this all develops.
Well, and you add the extra layer on top. As quickly as the tariffs come, they could go.
We saw, right.
We're seeing that. We're seeing that. So like all this is wrapped in that complete uncertainty package of as quickly as they come, they can go.
Yeah, right. And that's kind of like where I say like that's my concern. Like we saw with the DeepSeek stuff, for example, that happened. What was that? 27th of January, where it's like massive sell-off in AI relevant companies, and those all basically walked back all that was lost over the next 5 trading days, right? That's a really hard environment to talk through with clients, because when you see red on statements and you see red on the screen, like that's just challenging for anyone to look at, right? How do you find ways to rationalize staying optimistic on certain businesses when emotional trading takes hold and sends those companies down another 10%? It's really challenging, right? So I would say focusing on the long term on these types of conversations is that's what we're focused on, and that's what I think people should be really focused on. There's another hidden risk, not focusing on the long term, right?
Yep. I think one thing to add that you talked about the other day is we're going into this from a point of strength. So unemployment super low. Last print, actually it ticked down to 4% from 4.1. GDP is still healthy. Wage growth is healthy. So we are going into this trade war at a strong backdrop. So I think that's one good thing to keep in mind, as well as you're trying to kind of go with the flow and navigate through the volatility and sensitivity of this market.
And trade war is probably a bit of hyperbole, right? This could be a trade skirmish. This could be a trade dispute. I think we don't want to go there. I think it's a thing that gets lobbied about, but really, we'll see what happens.
Yeah. I guess just in closing, unless you guys have anything else, but talk to your advisor about these types of things. We have, I would say, a lot of good color on the things that we're doing behind the scenes. We've shared a fraction of them with you all today, but I think that's probably the best course of action for anyone that has their money managed, is that just maintain that pipeline of communication. I think that's what we called out as one of the biggest things to do in 2025. It's like active communication with your financial professionals. Mm-hmm. When you have volatility stoking events like this that come about, I think that just becomes all the more important. So hopefully we were able to provide some level of education around what these types of trade disputes are, some historical context, some of the headline direct and indirect impacts, and ultimately, again, some of the things that we're thinking about from an investment perspective. But if you do have more targeted questions, please don't hesitate to reach out to Blue Chip Partners, any of us at this table, or your advisor here, and keep following along from the content we put out on YouTube, on our blog, on LinkedIn, Blue Chip Family Media on YouTube. We're going to be staying close to this as the year kind of progresses. So look forward to providing updates as they come about to this trade spat.
Yeah, this could all change by the time this is released.
Right. Yeah, true. Right. Thanks again for watching. We'll talk to you all soon.